James, how important is the difference between a pause and a skip?
I'm not a massive fan of these linguistic acrobatics that central banks end up getting themselves into. But, you know me, John, I'm generally pretty critical of central banks. I think the Fed's done the best job out of the majors in the last, since their dovish mistake. I think the communication from Jay Powell and Neil Kashkari there, that's pretty much spot on, really, given where we are. They both recognise that a lot of work has been done, that obviously today's data is telling us something about yesterday, not about tomorrow. And of course, there is still a lagged effect from prior tightening, which is latent, which is not really yet acting on the economy. And so taking a pause just to buy themselves another month's worth of data, it's not like inflation has started going back up again, though of course the jobs market has been stronger than expected. If they can get a bit more data, get a little bit more clarity on the direction of travel for the labour market and the extent of core disinflation, I think they would feel more comfortable making a decision to hike at that stage. But my base case, like Gene, is that they're probably done here. I think we're going to see some of this data rolling over a bit more significantly in the coming months. I think that the bar to getting 10-year rate down to about 3%, a little bit on the high side, because at the moment we're still in an inflationary regime, and so there'll be some positive risk premium, term premium, inflation premium. But I do think the front end's interesting. The front end obviously reflects a probability distribution, looking at pricing and saying, hey, look, the market thinks the Fed's going to cut 50 this year. I don't think that's the right way to go about it. If you start scribbling down, probabilities of them doing another 25, another 50, them being on hold, or them even cutting, a little bit, cutting back to neutral or cutting a lot, you can quite easily get to the kind of downward slope that we've seen in recent weeks. And so I don't think that's as obviously a slam dunk to be short, depending on your subjective probabilities of the likely outcomes. And of course, that's a decent yield to own in the front end, pretty risk-free when risk assets look rich. So yeah, sure, there's time decay. If nothing really happens, you're going to lose a little bit of money as that 2-year rate just sort of rolls back up the curve. But I think you buy yourself a lot of optionality, because we've already seen that within the financial sector, as well as within the economy, there are potentially some significant potholes ahead of us.